Gents, it used to be easy. Europe was going one way, backwards. The US was going the other way, forwards. You'd extrapolate what that meant for monetary policy. That meant you kind of bid down the euro and euro-dollar was going somewhere towards parity. Michael, that's got a whole lot more complicated over the last few months, given the upside surprises we've had out of Europe. We're through 112, but you're saying go short now. Why?
So the markets at the moment are really being driven by sentiment, and the indicator that we have this morning saying actually now's a good time, you should be starting to fade this move in euro-dollar, is mainly driven from some of our quant models that say where the markets should be trading, where FX should be trading based on what's happening in some of the other markets. So basically it's looking through some of that investor sentiment. And you saw back in April, markets were very pessimistic on euro-dollar, and now that political sentiment has swung the other way with the focus on the US, and essentially we're saying that's gone too far.
Jay Barrow, the political spread has narrowed to some extent. Talk to me about rate differentials and what they mean for the FX world. Do you see the rate differentials really reconciling with what we're seeing in the FX market?
Well, you know, our take on the Fed is that they'll continue to go. We think they'll go again at the June meeting and then in September before they begin balance sheet normalization. But the market's far from pricing that in. We're pricing 70% odds the Fed will go in June, and really about 35% odds that they'll go again after that. So the U.S. market has pared back its expectations on the Fed as the inflation data has been tempered and as the market has sort of expected a little bit less or a lot less in the way of fiscal stimulus this year.
Michael, we had a paradigm shift earlier this year. Finally, the Federal Reserve decided to lead the market, decided to say to the market, no, we don't need you to be ready. We're going to tell you to get ready and we're going to hike interest rates. That happened. Why is the market still so far behind the Fed throughout 17-18, even though we had that shift earlier this year?
Yeah, very good question, Jonathan. So I think the market's still putting a lot of emphasis not on the central base case, which we often like to talk about, you know, in our forecasts and when we come and join you. But the market's putting the focus on the tail risks. And there's a lot of uncertainty around, you know, is economic growth really going to be sustained, particularly with some of the softer kind of hard data that we had during Q1, and also with some of the risks that are starting to emerge around China. Now, our view at BNP Paribas is that actually inflation is picking up in the US, the labour market is very tight, wages are going to be rising, and we think that China is going to be able to continue to muddle through. So that, for us, gives a very good outlook for the second half of this year and makes us very comfortable with some of those kind of reflation trades that people had on 12 months ago.
So, Jay, where's the biggest misprice? Is it going to be with spreads? Is it dollar? Is it treasuries, real rates?
Yeah, we are bearish on treasuries right now. As I mentioned before, we're largely pricing in our Fed forecast for June, but pricing in very little for the rest of the year.
How much is the misprice?
Well, we think the Fed should go twice more. We're pricing one hike and about 30% odds of a second after that. So we really think that by the end of the year, 10-year yields are currently trading 2.25. We think there is scope for them to move higher to 2 3/4, but it's more likely to be a back half of the year event as the Fed continues to tighten, but then as the Fed also normalizes its balance sheet.
So Jay, have the events of the last week, 10 days in D.C. changed your views at all?
To be fair, not really, because we as an institution have been expecting very little in the way of fiscal stimulus this year, just $50 billion this year and $200 billion next year. One would certainly think that given the developments there, this reduces the odds that anything gets done this year and pushes it into next year. And actually, to an extent, that is why we recently lowered our forecast, that plus the inflation outlook for our year-end targets for this year.
So, Michael, same question to you. In the FX area, have your views changed at all over the last 10 days or so because of what's happened in Washington?
So in FX, we haven't changed our views. We've taken profit on a few of the long dollar trades that we had on, so particularly a long dollar yen trade recommendation. So we took a premature profit on there. So really moving to the sidelines and really kind of waiting to reassess the outlook.
Is it clear to you that the dollar took a hit because of it?
I think the dollar's certainly taken a hit, but I think that's also playing through with what's happening in the rates markets. As was talked about earlier, you know, the rates market has really priced out expectations of the Fed this year. Some of that is because we've had some disappointing data from the US. All of this, I think, could turn around very quickly over the coming months.